Hello and welcome to another webinar with Everyday Money for Everyday People. My name is Todd Christensen, Director of Education at Debt Reduction Services, Inc. And this webinar will be addressing issues of credit, building credit, rebuilding credit, and what we can do to actually affect our credit. And some things that we can't do that are possibly myths that are out there. Very briefly, we are a nonprofit credit counseling agency, been around since '96, and our nonprofit charter is to provide financial education, and that's what we do for our communities. So here's what we're doing. We're going to go through a series of questions. The answers and possible answers will provide a basis for the information that we're discussing today. So question number one, which credit scoring model is used by most lenders? Is that going to be the Experian Plus, the TransRisk, the FICO, or the Vantage Score? I get a lot of answers on this one when I'm doing in-person workshops. A lot of people have heard about some of these scores. This really is a case of what is essentially a monopoly on credit scoring in this country. Probably about, on the low end, 85%, up to high end, about 95% of all credit-based decisions in this country are based on the FICO model. And that makes sense. FICO is the pioneer. They were the pioneer of the FICO, of the credit scoring system. Back in 1956, Mr. Fair and Mr. Isaac literally started their own company, called it the Fair Isaac Company, which eventually became, it was actually Fair Isaac and Associates, and then became Fair Isaac Company, and earlier this century became FICO. So it is FICO. Experian, TransUnion, those are two of the three national credit bureaus. They are for-profit companies, not government agencies. And the Vantage Score is a score that was created by all three of the credit bureaus, the third credit bureau being Equifax, working together to come up with a score that they were hoping would rival FICO. It is much more consumer-friendly than FICO, as we'll see going through this, but it has not been so far proved to be used by the business and by the lending community. All right, so as we go through this webinar, please do have a pen and pencil, piece of paper handy. Take down, note down the three passcodes. This is the first passcode, BUILD, B-U-I-L-D. You will need this if you're going to take the corresponding quiz to get credit for it. So BUILD is the first passcode. Okay, so what is the FICO score range? Where does it fall? Is it 1 to 100, 500 to 990, 330 to 830, or 300 to 850? Each of these are actually a credit score range. There are well over 1,000 credit models in this country, but which is the FICO score range? The answer, unfortunately, is 300 to 850. It would be nice if it was 1 to 100. That seems logical, but it is not. It's 300 to 850, and I've asked various representatives from the credit bureaus and from FICO itself why the 300 to 850, and the answer is either we really don't know, or it was not created for consumers. It was created for the lenders and their systems. So the 500 to 990, that is the range of the Vantage Score. And again, it doesn't seem very logical, but it is tied to, it's very similar essentially to the American school grading system. The 500 range is like an F. The 400 range, the 600 range is similar to a D. The 700 range is like a C, the 70%. 800 B, 900 range, an A. That's perhaps an oversimplification, but that's kind of the direction they wanted to go. And the 330 to 830, that's one of the credit bureau scores based on similar to FICO, but not an actual FICO score itself. So question number 3, how long does a bankruptcy stay on your credit report? Is it going to be 3 years, 7 years, 10 years, or forever? Anybody who has gone through bankruptcy probably certainly feels like it would be forever, but that's not the answer. Typically, a bankruptcy stays on a credit report for 10 years. Now, there is exception if it's the vast majority of personal bankruptcies in this country are called a Chapter 7 or liquidation, essentially trying to be discharged of responsibility to pay all debts. Of course, there are some debts that, such as student loan debts and any child or familial support cannot be discharged through bankruptcy or any usually recent back taxes and tax liens. But Chapter 7 probably makes up close to 85 to 90% of all bankruptcies in this country, and it does stay on all 3 credit reports for 10 years. The next most common bankruptcy is Chapter 13 or a wage earners. It's essentially a repayment plan that the debtor pays up to 5, 10, 15%. It's usually not much. It doesn't even approach 15% usually, but over a 3, 4, 5 year period. That typically stays on the credit reports for 7 years from the date that the original case was filed. 10 years is the standard answer on this one. Question number 4. Where do you go to get a free, no strings attached credit report? This could be a tricky one. Is it freecredit.com, report.com, freecreditreport.com, or myfico.com? For years, and even now, when I ask this question in classroom settings, I still get the wrong answers. Even though the federally mandated website where we actually get a free, no strings attached, no credit card required credit report has been around since 2004 as a result of the Fair and Accurate Credit Transaction Act of 2003. And that site is annualcreditreport.com. Every 12 months, you get a free credit report from each of the 3 credit bureaus. It does not hurt your credit. It does not impact your credit at all. There's no cost. They don't ask for anything to get it, but your name, your address, Social Security number, and then they ask for clarification questions based on what would be on your credit report. Quite often, just so you know, if you try to do this online, it is not uncommon for one or more of the credit bureaus to deny access if there is either incorrect answers given, or if there's something on the credit report that might be concerning regarding potential fraud. You might have to send in a request by mail or even by phone. For the information on that, you can go to the ftc.gov website or even annualcreditreport.com. You can find information there. Question number 5. Which of these events hurts your credit score the most? This is probably the number one question that I get the wrong answer to. Is it bankruptcy, foreclosure, short sale, or collections? And the number one answer I get So if this were Who Wants to Be a Millionaire, and they're doing a shout out to the audience, they'd always get this one wrong. Probably 75% of all answers I get is collections, when in reality collections is a collection account has the smallest impact on our credit rating. Bankruptcy, number one, anywhere from 30 to 35% typically drop. We'd see a drop in our score once a bankruptcy hits our credit report, followed by foreclosure, and then on our home, anywhere from 25 to 30% or so. Short sale, right about that same amount, which is getting a bank, your mortgage lender, to accept a purchase. So you're selling your home, you find a buyer, but they only want to pay less than what you owe, and you get your bank to accept that. It is not fulfilling your contract, the original agreement, so it's not being paid as agreed, even though you are finding a buyer and helping the bank save some money over time. But it still does hurt your credit. And then collections, anywhere from 5 to 10% per collection account. Now, I think the reason I get so many people saying that collections hurts the most is because it seems like once you get one credit collection account, there are 2 or 3 others very close behind, and so cumulatively it can have the same kind of impact as a bankruptcy. Question 6. Which of these has the most positive impact on your credit score? Is it monthly payments to your creditors, credit inquiries, or you're looking for basically applying for new lines of credit, the debt balances, how much debt you have compared to your potential debt or the credit limits, and age of accounts, how old are your accounts? So this one is about approximately 35% of our credit score is by our monthly payments. Are they on time? It's not so much are they more than what the minimum is. That would involve paying down our debt to limit ratio. But it's basically looking, are we on time? Are we in good standing? Are there accounts that are being reported as late? How late? So forth. We want to make sure that, above all else, if you want to build credit, above all else, you want to make sure that your balance or your monthly payment, at least the minimum payment, arrives on time. Credit inquiries, approximately 10%. If you were applying for a lot of new credit, but there's way too much attention paid to this portion of credit scores, in my opinion, by particularly reports in the media, because it's one of those sensationalized topics. Did you know that it hurts your credit every time you apply for credit? That can be true, but it's typically maybe 1% for every account you apply for. If you're only applying for 1 or 2 a year, it's not going to have much of a impact, if at all. If you're applying for 10 or 15 a year, yes. But that obviously doesn't seem rational. Debt balances, that debt to limit ratio. This is some people confuse this with the debt to income ratio. The debt to income ratio is a mortgage and a car lender industry term. It is not part of the FICO score. In fact, income is not on our credit report. So if it's not on a credit report, it is not part of the FICO scoring model or these other scoring models that we've seen. So debt to income ratio is not part of our credit score, general credit score. Now there are mortgage lenders, car lenders that will take into account your income for their own through their own systems. But on the FICO score, the income is not allowed by law, and so it's not part of the scoring. But this debt to limit ratio, basically what it's looking for is your debt equal to your limit? Are we maxed out on our credit cards? That's, of course, is a negative. We want to stay as far away as possible from our limits. There are some people who, while they may be well-meaning, will suggest that we carry balances 5%, 10%, 15% on our credit cards and don't pay off credit cards every month so that we can increase our credit score. Misguided is how I would suggest that is. Yes, you can have an extra 10 or 15 points added to your credit score if you're carrying a small balance, but that's usually surplus points. If you have you can have a zero balance every month, pay everything off every month in full, make all your payments on time in full, and you can still have more than the credit score, better than the credit score required to get all the best interest rates out there. So usually they're trying to tell people that you need to carry a balance so you can get the best credit score possible, so you can apply for and qualify for a loan. Unfortunately, the people that are receiving this sort of advice are typically don't have very good credit to begin with, and so carrying a balance on a credit card is a real dangerous activity. And then the age of accounts. This is looking at how old the accounts are. Statistically, it's pretty clear that the longer we've had credit, the older our accounts are, the better we are at paying as we agree. And that's really kind of what credit is. It's an indication of, are we paying as we agreed? Are we living up to those credit terms? Do we have a reputation for observing the agreement of the account? So if we're brand new to credit, and this is a generalization, it's true. As a group, people who are brand new to credit are not as good at paying their debts on time as those who have had credit for years and years. Now, who is not looking at your credit? Obviously, we know that lenders are going to be looking at credit, but who else is not? 3 of these are looking at our credit. 1 is not. So who's not looking at our credit report when making a decision? Is it the property managers, the auto lenders, the car insurers, or the paycheck lenders? Actually, most people do understand this one, that it is the paycheck lenders, because that's how they advertise. No credit check, very convenient. Because it's so convenient and they are taking high risk, they do charge extraordinarily high fees. And that's a topic for the Dealing with Debt webinar if you want to learn more about payday lenders, title lenders, and so forth. That's part of the Dealing with Debt webinar that we have. But these other 3 are looking at our credit when they're making decisions. Property managers, that makes sense. Are we making our payments on time to our credit cards, to our home, or to cars, our car loan? Then we're likely going to pay our rent on time. And so they will, on most, I should say many, applications to live in an apartment complex, and even small landlords can even do this. They will ask permission. They have to get permission to check our credit. And quite often, some of them will even charge us a $30, $40 fee to cover that credit check. Auto lenders, that one, of course, we know about. If it's a loan, they're wanting to look at our history of how we've performed on past loans. And car insurers, this is one that surprises a lot of people. Why does a car insurance company care what kind of credit I have? And a lot of people will say, and this was my initial reaction, well, maybe it's to see if we're going to make our premium payment, our monthly premium payment on time. Very little to do with that. The studies that they base this on, they justify this action, basically show that as a group, again, not individually, but as a group, groups with lower credit scores, some studies suggest they get into more accidents than groups with higher credit scores. Other studies suggest that they submit more claims and larger claims to the insurance company than those with higher credit. And that seems pretty frustrating to a lot of people, especially if they have credit that is not stellar. Seems unfair, but you know, car insurance, it's not about being. It is actually fair, as fair as charging higher premiums to young men, 25 or under 25, who are not married. They pay very much higher car insurance premiums, I can tell you this from experience, than women of the same age, or older men, or older women. Or it's all about groups. It's not about the individual. It is true that men under 25 are going to, as a group, will get into more accidents than other groups. That doesn't mean that when I was 24 years old, I wasn't married. That doesn't mean that I was a bad driver. But as a group, because I belonged to that high-risk group, I paid higher monthly premiums. Because somebody belongs to a high-risk group, which in this case is low credit scores, they're likely to pay higher insurance premiums. And that's used to be maybe half of insurance companies 10 years ago, 15 years ago, back in the early 2000s, were checking credit and basing a portion of the premium, determining a portion of the premium on credit ratings. Now it's if it's not 100%, it's pretty darn close. Okay, the second passcode here is SCORE, S-C-O-R-E, SCORE. So write that one down. You'll want to include that on the quiz. Question number 8. What's the average credit card APR, annual percentage rate, in the U.S. for accounts in good standing? So this does not include accounts that are late, overdue in collection, so forth. Is it 10 to 12%, 14 to 16%, 18 to 20%, 22 to 24%? This is another one I get a lot of answers that are off, that are nowhere near the correct answer. A lot of people immediately assume that everybody has high interest rates, and so they'll guess 18 to 24 in that range. The reality is, it's since the early 2000s, as long as I've been tracking this, it's been somewhere between 14 and 16%. Now, there are cards that have interest rates lower than that. There are cards that have interest rates higher than that. But that's the average. What that means is that for every $1,000 in balance we carry on a credit card, we're probably going to pay somewhere in the neighborhood of $150 a year just in the interest. So if we have a higher interest rate, if we maybe have missed a payment and been hit with this, what's called a default, it's really a penalty rate, and we're in the 25% range, then we're likely going to be paying $250 a year in interest if we're carrying a $1,000 balance month after month. So the higher the interest rate, it's not just interest rate does not determine or impact our minimum payment. It does impact the amount of interest that we pay over time. Question 9, when starting to build or rebuild credit, where's one of the best places to begin? So there's a lot of options here, a lot of things out there that you can read. How do you build or rebuild credit? Now, I'm going to go through a few of the products, loans that we can use to build credit. Are we going to talk about going to a major credit card first, a tire store, home loan, car loan? The reality, though, is there's a couple of things to do even before applying for credit, this traditional credit, where there are no additional fees or interest. So one of the things I suggest is, even though it doesn't have an impact on our credit, is make sure that we have checking accounts and savings accounts that we're not bouncing checks that we don't have overdraft, and because overdraft, if it does go to collections, can actually hurt our credit. But otherwise, bank accounts do not impact our credit, but they are good indicators of good financial management. Most utilities, electricity, heating, and similarly cell phone contract companies do not report our payments to our credit reports, to the credit bureaus, although they could. If we receive the service and pay for it later, it is technically a service credit. And so in many states it can be. There are some states that have regulation that don't allow utilities to report our payments, but you can check with your utility company. If you have made payments on time to them for years, ask them if they would please report to the credit bureaus. If they do, it can have a positive, albeit fairly small, impact on our credit. Another option that's typically free is become an authorized user on traditionally a family member or parent's credit card account. An authorized user card looks like any other card, but the person whose name is on the authorized user card is not responsible for making payments. They can use it, but they don't have to make any payments. I mean, they should, but the account holder is the one that's responsible for paying that. It's traditionally it's been meant for young adult children who are just starting to build their credit, and a parent will get an authorized user card in their name. Great for sending kids off to college with an authorized user card. The parent can see exactly what their child is spending, making purchases for, and yet the child can focus on school rather than well, it's not a bad idea for them to make payments. But if it's for textbooks and that sort of thing, if a parent has agreed to pay that, at least they get to see what the purchase are on. And so the positive gets reported. If there are late payments, typically they don't negatively impact the authorized user. It is supposed to be a one-way positive flow of information. Now, that said, about 1 in 4 credit reports has pretty negative, incorrect information on it, things that are being reported that shouldn't be, and 1 in about 20 is so bad that the person can be denied credit based on some of those errors. So these are a couple of the free methods of building credit from scratch or rebuilding it. Once you start applying for loans, though, where do you start? People who've gone right to major credit cards, National Bank, Visa, American Express, are very likely to be denied credit because they don't have credit. And so they think, well, how am I supposed to build credit without getting credit to begin with? It seems like the chicken and the egg dilemma. But the idea is that we shouldn't be starting with the major credit card. There are other places to start. Don't go to a car title loan. Don't go to a payday loan, because if they're not checking credit, which they don't, they're also not reporting history to their home loan. As you can imagine, it's hard to get a loan for a home if you don't have any history of credit. So one of the places to start might be a tire store. Typically, tire stores and other retail establishments, gas station cards, are more likely to approve people with credit that is less than stellar, but they're also going to charge higher interest rates in the 20 to even 30% range. So one of the things I suggest is, if you're going to get tires or brake work done on your car, and you're ready to start building your credit, save up the money for it, the cash, so that if you wanted to, you could pay in cash. Apply for a loan at one of these stores and then either pay it all off within the month. It'll be reported as paid in full, or pay all but just if you really want to maximize your monthly payment benefit. Let's say you had $500 worth of work done, you pay $450, and then that extra $50 you pay off in the next 6 or 7 months with the minimum payment. So just another way of looking at building credit. There are other ways, such as a secured credit card. If you're looking at getting a secured card, just be aware that it needs to be reported to the credit bureaus. Not all secured cards report to the credit bureaus, and if it's not reporting, it's not helping you build credit. Secured credit cards, they look like a combination between a credit card and a savings account. You give the bank a certain amount of money, $300, $500 or so, that goes into a secured savings account that you can't touch until that the credit card that's tied to it is closed or converted to a standard credit card. There are typically annual fees. I've seen monthly fees. I've even seen per transaction fees. So the downside to secured cards would be all the additional fees that can really put a dent in our wallet. Question number 10. What is never on your credit report? Now, if I know you all were paying attention earlier, you heard the answer to this one. Is it your name, Social Security, your credit accounts, your employer information, or your income? It is, of course, your income by law in the U.S. There are countries in the world that where income is a factor in our credit reports, because it is an indicator of potential risk or not. But there are ways of getting to that, predicting that kind of risk without income that are credit, that's FICO, that's kind of what they do. Name and Social Security, that makes sense. When you print off, if you ever print off your, do click the button that removes the Social Security number from your report. You don't ever have paperwork laying around that has your Social Security number on it. Number one easiest way to commit identity fraud is to use somebody's Social Security number. Of course, it has your credit accounts on it. That's the main focus of a credit report. And employer information, it will be there. It's sometimes for a lot of people it's not accurate. And one of the questions I get here is, what government agency is spying on us and reporting all this information? And I'll hear, it's the IRS, it's Social Security, it's this, that, the other, Area 51, whatever it is. Look, there is no conspiracy theory here. The boring truth of the matter is, every time you apply for a loan, it's going to ask you, what's your name, what's your Social Security number, who do you work for? And in the paperwork, in the fine print there somewhere, it's going to say every time, by applying for this loan, you give us permission, us the lender, to retrieve information from your credit report and to submit your updated information to the credit bureaus. So all this information on the credit report, personal information, comes from our own doing. We submit it. We include this. And that's one of the reasons why you'll see a lot of different names on your sometimes on your credit report. Sometimes it'll include a middle initial. Sometimes it'll include a title, the junior or the third, or have a maiden name. Why so many different names? Because that's how we've applied for loans in the past, or accounts. All right, and because we're having so much fun, let's talk about this bonus question. What do most lenders consider a good minimum FICO score? So when we're talking about a good score, basically what we're talking about is, at what score will you typically receive or be approved for the best interest rates, the best terms that the lender has? Are we talking 650 plus, 690 plus, 760 plus, or 790 plus? Of course, the higher the better, but typically for most mortgage lenders, 760. Although if you look at anything through the FHA, Federal Housing Authority, typically they're looking at 690 or higher. Most credit card lenders, it's going to be probably in the 760 range. Some may go down to 725. Some may go up to 775. So when somebody says, I have excellent credit score, that's actually, there's no way to say you have an excellent credit score, because your score is not excellent. It's just a score. And it's up to the creditor to determine if they like your score enough to give you the best interest rates or not. So credit score judgments vary by creditor. Okay, so let's just talk briefly, last few minutes here, what's on a credit report? Okay, so there are our identifying information, contact information, our address, social security number, our employer information, as I mentioned, but no income. The biggest portion and most important typically is the details of all of our credit lines or loans, credit cards, and so forth. And that information will have, those lines will have who we owe money to, who we borrowed money from, when that account was opened, if it's closed or open still, or if it was closed, when it was closed, who closed it, did we close it, or did the lender have to close it, what's the original balance, what's the highest balance we've ever had, what's the current balance, what's the repayment, what are the repayment terms, how many late payments we had, if we've had late payments, how late. And so you see there's a lot of details under our credit lines. Other sections, and each credit bureau, by the way, has a different format. And one of the questions I get quite often is, why do we have 3 credit bureaus? Why can't we just have one? The answer to that is in the question, why do we have so many different makes and models of cars? Why can't we just have one American manufacturer instead of as many as we do? The reality is these are for-profit companies, and they each believe they can do a better job than the others of providing credit services. So they all have a different format on their credit reports, but typically these sections are on each of the credit bureaus. The next section would be a public records section. This is where you would find listings of bankruptcies, tax liens, judgments against us. This does not include criminal activity at all. It is financial related. Another section would be the inquiries. This would be list all the creditors that we've applied for accounts from in the last 2 years. Only those listed in the last year, though, are taken into account on our credit rating. Typically, things that stay on our credit report, negative stuff like missed payments, so forth, will stay on for 7 years. And then they should automatically drop off, although that's one of the common errors on our reports. Things don't drop off when they're supposed to. But the older an item of information is, the less it impacts our credit. And that's because as a predictor, it becomes less and less reliable the older it is. Think about it this way. The way you handled money last week is a much better predictor of the way you handled money 5 years ago or 7 years ago. We change. And so the more recent the item, the more reliable it is as a indicator of kind of risk we are to the lenders. And so it has a greater impact on our rating. There is also a section where if we want to, we can add a personal statement up to, it depends on the credit bureau, but it might be up to 100 words to describe. I usually say don't use it to explain accurate information. If you missed payments because you were out of town and didn't get your bills, creditors don't really care about that. In fact, they say, well, you should still be making your payments, even make arrangements for payments even if you're out of town or if you're in the hospital. Whatever, they don't want to know why you didn't make payments if it was accurate. What I would suggest using this for is if there's inaccuracies or errors on your credit report that you're having a hard time getting removed, and we'll talk about disputing errors in just a moment. That's where we want to say something like, such and such an account belongs to my uncle who has the same name as I do, lives in the same city, and it's under dispute, but often appears on my report. So that it would have, it's not taken into account on our credit score, but any lender, potential lender, who is looking at our credit report might see that and say, oh, okay, well, tell me about this. Okay, I can see that. And so they might adjust their application process accordingly. What is not on a credit report that a lot of people are not sure of, race, religion, ethnicity, political party, those kind of standard discriminatory factors. Age cannot be taken into account when applying for a loan. And this is a surprise to a lot of people who think, well, what if I want to get a 30-year mortgage and I'm 85 years old? As long as your financials support that, there's nothing that the lender can't deny a loan based on your age. Criminal records, as I mentioned, is not there. Traffic violations are not on our credit report. Okay, so moving on. I mentioned something about disputing errors. If you do notice, you pull your credit, you notice there are errors on it, things that should have come off that are not, things that are not on there that should be. Keep in mind, though, again, something even making if you pay off a debt, one of the things people think of is that it's supposed to come off your credit report. It does not. That payment will stay there in the account, corresponding account, for at least 7 years. If it's in positive good standing, it's going to be there for 10 years, and that's a good thing. So negative information, because it remains an indicator of future risk, negative information and positive information stays on our credit report for 7 to 10 years, even after we've paid off an account. So paying off an account, and if you pay off an account and then you go to your credit report and you see that it's still there, it's not something you dispute. It's still going to be there for up to 7 years. So if you do see, though, that maybe there's information that's 10 years old, or that there's an account on there that doesn't belong to you, or the account balance is very inaccurate, maybe you paid the balance off 3 months ago, and it's still showing a high balance, that might be something you can dispute. It typically does take about a month, but sometimes up to 3 months for a balance to be information to be changed on your credit report. Creditors, most of them will report activity every month, but there are some that only report every 3 months. But if you want to dispute something, you go directly to the credit bureau, or technically what they're called is the Consumer Reporting Agency, to their website, Equifax.com, Experian.com, TransUnion.com. And on the home page, you should find an error dispute option. You may have to dispute the same item on all 3 websites. In the past, and I know there's discussion about changing this in Washington, D.C., but in the past they don't have a way of disputing it on one and having that forwarded to the other 2. Just be aware that there are some organizations, credit repair companies, that may charge hundreds, if not thousands of dollars to dispute errors for you. And again, this is something, though, that you can do for free. They may claim that they can dispute it and get things taken off by bombarding the credit bureaus until they miss one. Credit bureaus got wise to that and pretty much have put in place systems that once you dispute an item, they're not going to accept more disputes, any more disputes for that. And even if they did, your credit score can go back down, or the error, the item that you're disputing, even can return to it if the record keeper, if the creditor has legal proof that it's accurate. So what is fraudulent is any organization telling you they can remove accurate information from your credit report. They may say, hey, if it's unverifiable, then it can get removed, and then they will talk about accurate information that may be unverifiable, and that's true. And so whereas it may not be illegal, typically it is unethical because you're trying to create a representation of yourself that is inaccurate. And I see this with people trying to apply for a home loan in advance of applying for a home loan. They try and go through all these ways of building up their credit artificially to qualify for better interest rates that they shouldn't be able to qualify for, and then I suggest, isn't that kind of the whole reason why we had the downturn in the economy back in the mid-2000s, late 2000s, because people were getting into home loans that they couldn't afford. And the reality is, people get in if they artificially improve their credit score, they don't typically. I mean, it's human nature. They don't just say, okay, well, we're going to pay less on our credit on our home loan now. What they typically do is get into a bigger home, and so they again are getting into a loan that they typically can't afford. Okay, so here are the steps that you would go through. If you would dispute an error on your report, many of those errors might come off within a week. Others, you might have to have direct contact with the creditor. If you receive within that, you usually have 30 days for that dispute to be resolved. If at the end of those 30 days they come back and they say, and the creditor says, no, this is accurate, that's where you need a paper trail to prove to the creditor, or ask them to prove because if they say no, it's accurate, then they're saying that they have proof. So this is where the paper trail becomes important. Access your report. You're going to need the credit file number on that report for the item that you're disputing. You choose you'll access the internet website, the Experian, Equifax, or TransUnion.com. The dispute error option. It'll ask you for your report number. You enter that. Choose the item that you want to dispute. Once you choose the item, then it'll give you a drop-down menu of reasons why you're disputing it. It's not yours. It's an incorrect balance. It's an old account, whatever it might be. Choose that, and then you can add up typically anywhere from 100 characters to 100 words. Depends on the credit bureau to explain why you're disputing that. It usually only takes about 5 to 10 minutes to dispute an error. Very quick. Yes, it is simple, but there's no guarantee it's actually going to work. But do dispute items that are invalid or incorrect. Numbers of the day: 75% and 5%. 75% of credit reports have some sort of error on them. Most of those errors, the vast majority of those errors, are transcription errors, maybe a misspelling on a name, or the numbers on your address are backwards, and that can be from our own input if we're applying online, or maybe if we wrote everything down on an application and it was not as clear as it was supposed to be. Maybe there was some inaccuracies in the transcription. So 75% have some sort of error, but only about I've seen as low as 5%. I've seen as high as 25% of credit reports have the sort of error that would actually prohibit the consumer from getting a loan versus if that error were not on the credit report. So in 1 in 20, between 1 in 4 and 1 in 20 credit reports have an error that's so egregious that it'll keep the person from getting a loan that they otherwise would qualify for. All right, third and final passcode for the day: SMART, S-M-A-R-T, SMART. Okay, so here's where we go to get the annual credit report, our free credit report, annualcreditreport.com. There's the address if you want to do it by mail. Central Source LLC at P.O. Box 105283, Atlanta, Georgia 30348-5283. There's no credit or debit card required, no trial service or subscription required. I mentioned the credit score goes from 300 on the low end to 850 on the high end. As a reminder, the higher the score, because credit is an indicator of risk to the lender, the higher the score, the lower the risk we are to the lender. So we do want higher our scores to be higher. So what does it look like on a national distribution of scores? This has been fairly similar over the last decade. On the very low end, people under 500 points, there may be 1 to 2%, and most of those, almost all of those, are in the 480, 485 or higher. I can only think of a couple of people I've seen there whose credit reports I've seen in the past 10 years that I would probably guess are in the upper 300 range. But most people, even after filing for bankruptcy, most people are going to end up in the 500 to 550 range. But you can see that about 40% have that score that we talked about, how most lenders would consider them to qualify for their best interest rates, or consider them to have excellent credit. By the way, when you get your free credit report, be aware that it does not come with our free credit score at the moment. Again, that's something else that DC has been pushing back and forth, wondering if they should require the credit bureaus to do that. In the meantime, though, if you want your actual FICO score, you have to go to myfico.com, and it's going to cost you probably $20 per score, or you're going to have to sign up for a subscription service at $10 or $15 a month. Unless you're getting ready to make a major purchase on a home, I typically suggest that it is not something you need to do. There are a lot of new scores, new programs out there. Some credit cards are offering free scores with their accounts. They may even call them FICO scores, and they may be a FICO score, but they're FICO has dozens of different versions of their score. The free scores that you get out there are not ones that are going to be used by any lenders, but whether it's through a credit card company or whether it's through something like a Credit Karma, Credit Sesame, as in the sesame seed, Credit Sesame, Bankrate, mybankrate.com, several of these, and there seems to be new ones coming along every month that will give you access to a free credit score. Those scores, again, they're not the actual FICO scores, but I would suggest you use them for educational purposes. If you notice from one month to the next that your score drops precipitously without any reason that you can think of, it's a good indicator that there's something just happened on your credit report during that week, during that month, that you should be concerned about. There may be some fraud going on, or an account that you were not aware of, or there's some errors on there. So I use those free scores for those purposes, just to look for patterns. And then here's a nice pie chart of the FICO score based on information that FICO releases. It is a proprietary model. They don't release all their specific information because it's essentially considered a trade secret. But this is a general representation of how your credit score is determined. The largest portion from the payment history, on-time payments, so forth. The next largest from that the balance to credit limit ratio. How old, the length of credit history, that's how old your accounts are. Pursuit of new credit, are you applying for a lot of new credit or not? And then a credit mix. Do you have various types of credit, or is it just the credit card, or is it just a store card, or on the negative side, is it just a finance company? There are some type of loans, like a kind of a corner finance company, that actually can hurt your credit. So in the workbook handout, if you go back to where you accessed this webinar to begin with and find the corresponding handouts, in that excerpt, you'll find that there is a form for rating yourself, rating your credit on your own. Basically what you do is you look through the 5 general credit score categories and ask yourself, if I were the creditor, how would I see that? Or if I were lending this person money, what would I think about their history of payments or their balance to limit ratio and so forth? And then you can identify your top 3 steps to improving your credit rating. And then, of course, you'll want to fill out the report request. You can go to ftc.gov, or you can just go to annualcreditreport.com to fill out your credit report. So if you have questions about your credit, consider contacting a nonprofit credit counseling agency nearby, or an organization like Debt Reduction Services that you can contact by phone or online. Nonprofit credit counseling agencies are nonprofit because of their financial education, so they are required to provide you with information, and most of the time it is or should be free. If it's not, find another one, or find one that's at least very affordable. And it's typically unbiased versus somebody who is trying to sell you a product or a service. So with that, I would also suggest that you consider completing all of our workshops. Never stop learning when it comes to money and life generally. Look at the other webinars that we have available on our website, and consider taking those and submitting the quizzes for credit. So that is the end of our class today on building and rebuilding credit. I appreciate you joining us today. Again, for Debt Reduction Services, Inc., I am Todd Christensen, Director of Education. I appreciate you joining me. Bye-bye.